Welcome back to the Daily Hunt for Multibaggers, your go-to source for AI-generated market commentary and speculative analysis. Today, Tuesday, October 21st, 2025, we're diving into the data collected from Monday, October 20th.
And what a day of data it was, Ethan. Our system flagged a significant number of posts across a variety of stocks. While there's a lot of community excitement out there, my initial read of the key performance indicators suggests that today's market sentiment is leaning heavily towards the risky side for many of these names.
You always find the silver lining in the cloud, Brooke, but I'm sensing a lot of caution in your tone already. Let's see what the numbers really tell us. All right, first up, we've got Galaxy Digital, GLXY. Our system picked up 19 new posts on this one yesterday. The community is buzzing, talking about putting their entire savings into it, expecting anywhere from 3x to 10x by 2026. There's massive hype around its potential in both the crypto and AI data center sectors, with Q3 earnings being eyed as a major catalyst. It just screams growth story, you know?
Well, Ethan, I appreciate the enthusiasm, but when I look at the hard numbers for GLXY, I see quite a few significant risks. The original posts might claim it's on sale due to a tariff fiasco, but the current price is actually very close to its 52-week high of $44.33. That really contradicts the idea of it being a bargain. Fundamentally, the company is unprofitable, with a negative net profit margin of almost negative 13% and an EPS of negative 0.9. Add to that a very high debt-to-equity ratio of nearly 150 and really low revenue growth at just 2.2. That high beta of 3.847 means extreme volatility, which when coupled with these financials shows significant risk. Given that this is a new stock for our AI-generated insights, my take here is a clear stay away.
All right, the numbers do tell a story. So for GLXY, despite the community hype, the verdict for today's speculative analysis is stay away. And next, let's talk about American Battery Technology Company, ABAT. We saw 36 posts about this one yesterday. Now, a user claimed a quick 20% gain on a speculative trade, and some feel the $58 million grant termination was political, not a fundamental flaw. They point to the company's progress on its pre-feasibility study and long-term potential in lithium recycling.
Ethan, a $58 million grant termination is a massive setback, political or not, and it caused a 50% stock drop. Our AI-generated analysis has previously rated ABAT as a stay-away or speculative gamble, and frankly, the key performance indicators haven't improved. We're looking at negative EPS of negative 0.8, a negative operating margin, and a deeply concerning debt-to-equity ratio of over 11. This means the company is heavily reliant on debt, not profits, to operate. A very high price-to-book ratio of 9.27 for an unprofitable company suggests it's potentially overvalued relative to its assets. Even with some revenue growth, the underlying financial health is simply too poor.
So even with the belief in future lithium demand, you're not seeing the light here.
Not in its current financial state, no. For a true multi-bagger, we need a healthier financial foundation. So for ABAT, my AI-generated insight is again a stay away.
Okay, another stay away for ABAT, consistent with our previous speculative analyses. Moving on to JD.com, we saw about 20 posts yesterday. The original post tried to build a bullish case, citing low PE and PB ratios as potential signs of undervaluation, a crouching tiger ready to pounce, as they put it. Some might see long-term value in their market position in China.
A crouching tiger with a negative operating margin, Ethan. Their core operations are currently unprofitable, and the broader market sentiment is quite bearish, with users explicitly stating it's been a dog and needs to fall further. That very low price-to-book ratio of 0.211 isn't necessarily a sign of undervaluation. It often indicates the market is pricing in significant regulatory and geopolitical risks, which are very real with Chinese tech. Beijing halting their stablecoin plans is a prime example of that intervention.
But they do offer a 3% dividend yield. Doesn't that count for something in terms of stability?
A dividend yield, while nice, typically doesn't compensate for fundamental unprofitability, significant regulatory headwinds, and a declining stock price. Our AI-generated commentary has consistently pointed to stay away for JD, and today's data reinforces that. So again, stay away.
All right, JD.com, despite the potential tiger imagery, remains a stay away for our speculative analysis. Let's talk ACHR Airvation. Electric air taxis, Brooke. This is exciting. The future of transportation. They signed a major deal with Korean Air for 100 eVTOLs, backed by Boeing and Stellantis, and had successful high-altitude test flights. The original poster was very bullish due to past personal gains, saying this news is very good. That's exciting growth potential, isn't it?
It sounds exciting, Ethan, but the most upvoted comments are quick to point out that this is old news and already priced in. And when you dig into the financials, the company is deeply unprofitable and burning significant cash, projecting widening EBITDA losses. We're talking negative EPS of negative 1.35, zero net profit margin, zero operating margin, and a high debt-to-equity ratio at 4.855. Exciting partnerships are great, but they don't automatically translate to sustainable investment if the company can't turn a profit. And with a beta of over 3, this stock is incredibly volatile, making it a high-risk gamble on potential and not current performance.
So the partnerships and technological breakthroughs aren't enough to sway you for a growth play here?
Not when the financials are this stark, no. The risk of capital erosion is too high. Our previous AI-generated insights for ACHR were stay away, and today's analysis confirms that. The verdict here is stay away.
Understood. ACHR Airvation, ACHR, is a stay away, according to our AI-generated analysis. Finally, JetBlue, JBLU. The original poster was trying to make a bullish case ahead of earnings, suggesting it could go boom. They highlighted an operating profit in Q2 and mentioned the United partnership eventually should provide a margin kicker, right? Ethan, that operating profit for Q2 needs a lot of clarification. Our AI-generated analysis shows they actually had a GAAP net loss of about $74 million for the quarter. That's not what I'd call profitable. The community sentiment strongly suggests it always falls on earnings, which is a serious red flag going into an earnings call. Fuel prices are projected to increase in Q3, contrary to the bullish assumption, and they face rising non-fuel costs and engine constraints grounding planes. Their debt-to-equity ratio is astronomically high at nearly 391. With negative net profit margin, negative EPS, and even negative revenue growth, this is a very distressed company. The United partnership benefits aren't even kicking in until 2027, and it's also facing regulatory scrutiny from the DOT.
Wow, 391 debt to equity. That's a number.
It certainly is. It screams significant financial risk. This is a new assessment for us, but based on these metrics, the AI-generated insight is a definitive stay away. All right, JetBlue, JBLU, is a stay away as well. It seems like a tough day in the market commentary for a lot of these names.
Investigate as buy. None. Investigate as cautious buy. None. Investigate as speculative gamble. Galaxy Digital Inc., GLXY.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses.
The market is a wild place, and knowledge is your best asset.
Thanks for tuning in to the Daily Hunt for Multibaggers. We'll catch you next time.